The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning, Long Island. You are listening to Money in the Morning with Mitch Goldberg. You're listening on 103.9 FM, LI News Radio. Thank you so much for joining us today. You know, on a day when the stock market is closed, financial markets are closed today for a holiday, it's a good thing because it gives us a chance to focus on what's really important, the things we can control. And when the market's open, we have a tendency to focus on it. We go through the futures, the updates, the news, the economic reports, the big statistics. We put it together, what it means for you. And then we help you formulate a plan. We help you decide if you have a strategy, an investing strategy, and a financial plan that you could stick with. And this show is all about making sure that your money works hard for you, because you work hard for your money. And this show is all about helping you make your money work for you so you could become the best possible version of your financial self. And we're really passionate about this. Okay. I am so passionate about helping people with financial literacy, investing, financial planning. And since it's a day that the market's closed, let's get into focusing on the things that we could control. Okay. What I want you to think of is this. Okay. Financial order of personal finance. I as a financial advisor for over 30 years, I've had the opportunity to sit down with so many people, so many clients, so many different situations. And there's a certain order that people follow that helps them become successful as retirees. It helps them become successful as planners, as people who achieve a goal. And this is non-negotiable. And I'm not here to tell you what to do, but I'm certainly going to tell you what has worked and what has worked the most consistently. And it's very, very simple. And the financial order of operations goes like this: an emergency fund first, health insurance, life insurance second, savings third, and investing fourth. That's the order. It's four things. That's your financial order of personal finance. And if you don't have those in place, nothing's going to work for you. And what I mean is this: the way I'll describe it is, I sit down with prospective clients and I could tell who has their order in place and who doesn't, because I often will sit down with somebody who's got an IRA or a 401k that they want to roll over to an IRA. And, that's what they have. That's great that they were able to accumulate some assets. But when we get to talking, they're living hand to mouth. They're using their credit cards as their emergency fund. They have nothing in savings. So anytime an expense comes up, it's always an emergency. And that's what I mean by financial order of personal finance. When I work with a client like this, or a prospect, I should say, I often actually don't take the client's account as a financial manager. I don't work with the client because they're not ready to be a client. Because in my experience, every time I've taken on a client who doesn't have all of the pieces in the puzzle organized in the right order, it's just a matter of time until that client calls up and says, I need to take an IRA withdrawal for an emergency. I need to take money out of my IRA for this, for that. And these are generally people who are under 59 and a half. They're paying the 10% penalty for early distributions, again, before age 59 and a half. They're paying the taxes on the money, so they're not even getting all of the money to use. And what a lot of people do is they don't even do any tax withholding, and they just get hit with taxes at the end of the year that they don't have the money for, and then have to take out even more money the following year from their IRA. And this just goes on and on and on. So I can basically tell that when a client doesn't have this order in place, it's just a matter of time until they blow through their investing. I'm going to do all the work for them, right, as a financial advisor, but they're not going to be able to be a client long term. And it's not to my detriment, it's to their detriment. So personal finance is critical, and that is actually more important than just investing. I know we focus on investing and the stock of the day or the crypto of the day, but by and large, in my experience, financially successful people who are ready to retire financially, who can afford to retire financially, they didn't have any magic power. They didn't have a knack for picking better investments than everybody else. What they did have was common sense and this order. They had their emergency fund first. Then they had health insurance and at least a little bit of life insurance. And then they had their savings account. They had those before they even invested any money. And they get through those steps pretty quickly. Now, if you're in hock up to your eyeballs, I'm sorry to say this, I don't want to insult anybody. I want the show to be for everybody. But if you're living hand to mouth and there is no room whatsoever to even think about building an emergency fund, you have no business investing in the hot pot stock or the next hot crypto or the next hot artificial intelligence stock. I'm sorry to say, because what you're doing is you're gambling, and your investment style is the Sunday punch strategy, where you're looking to put a little bit of money that you can't even afford to lose into an investment that's going to yield such a huge return that will make up for all of the past financial mistakes and lack of savings and an emergency fund just in one fell swoop. And it doesn't happen, folks. And I've been doing this for so long right here on Long Island. It doesn't happen. Even when people do make a couple of bucks on a quick speculative investment, they don't sell it, or they think it's going to go higher. They get greedy and they wind up just riding it up and then riding it back down. And if you're listening to this thinking, oh, darn it, that's me, you are not alone. So we need to break the cycle. But I meet with people all the time who are financially successful, and I could tell right away if they are set or not. And it doesn't matter if they're 30 years old, 50 years old, or 70 years old. It's always the same. They always have this order. And if you don't have the order, think of it like this. If you don't have an emergency fund, you are always literally one or two emergencies away from being broke. No money to pay for anything, for rent, for food, nothing. A credit card is not an emergency fund. I know a lot of people use credit cards for that. Say, well, I would only use it as an emergency. If you get 2 or 3 emergencies at the same time or in quick succession, you probably will max out your credit cards very quickly, and then you're stuck. And not only are you stuck with 19.99% interest, you have no more money for anything else. An emergency fund is just a sign of financial maturity. If you don't have the emergency fund, you're financially immature. That's a problem. The next thing is health insurance, because health reasons that's the number one reason why people go bankrupt, is for health-related expenses. So if you don't have health insurance, you sure as heck don't belong to the investing world. Not yet, anyway. And a little bit of life insurance, because if something were to happen to you, you disappear, you get hit by the proverbial bus, you've got to be able to leave something behind to your family so that they're not in dire straits. Having a family and not having life insurance, that to me is also a sign of financial immaturity. And I'm not trying to sell you a policy here, okay? I don't care how big the policy is. This is, small term policy. They're fairly inexpensive if you can get life insurance. If you have substantial health issues, obviously life insurance is not in the cards for you, but there are other things that you might be able to do. But that's number two. The third step is savings. Okay, the music is coming on, but I really want to get through this. So we're going to talk more about this on the other side of these brief messages. We're going to talk a little bit about saving, and we're going to talk a little bit about investing, and then we're going to continue on our path down the financial journey, personal finance. You're listening to Money in the Morning with Mitch Goldberg. If you want to take this conversation offline and get into it a little bit more deeply, check us out. I am moneyinthemorning.info. Okay. Moneyinthemorning.info. You're listening to 103.9 LI News Radio. We are so grateful that you chose to join us this morning. And if you're listening to this in an evening replay, thank you to you as well. And we will be again right back. Please stick around. And we are back. Thank you so much for joining us. You're listening to Money in the Morning with Mitch Goldberg. I'm your host, Mitch. And if you'd like to follow up on a one-on-one conversation with me, or if you want to learn more about us, check out moneyinthemorning.info. We are talking about personal finance. We thank you for joining us here at LI News Radio 103.9 FM. We're talking about personal finance on a day when the stock market is closed. It gives us a chance to think. You know what I do the least of during the day as a financial advisor? Looking at what the stock market is doing at the moment. It's not so relevant to me on a minute-to-minute basis what the S&P 500 is doing or what the NASDAQ is doing. It doesn't matter. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. What I focus on are the things that we can control, that you can control. Talking about control, we're talking about the financial order of personal finance, and that is emergency fund, health, life insurance, savings, and investing. Look, we could maybe leave out life insurance and just go emergency fund, health insurance, savings, then life insurance and investing. But to keep things simple, I want to keep the life insurance part in it. Okay. This is important to talk about because every client that I've ever seen who became a successful retiree, someone who can actually afford to retire, in the nice, decent lifestyle that they wanted, followed this order. They always had an emergency fund because if something happened, emergencies come up, they didn't have to take money out of their IRA early. And when you take money out of your when you take money out of your IRA, you not only pay a penalty, you pay the taxes. So you're just, you're losing so much money. It's a lot more than just taking money out of your IRA. You're losing money to taxes and penalties. There's a 10% penalty when you take money out of a traditional IRA when you're under 59 and a half. So having said that, people who are successful gave themselves time to make money in the market by allowing their money to compound, to grow. And then you get growth on the growth. And it continues for years. And if you're taking the money out, you lose all that time for your money to compound. So you must have an emergency fund to avoid having to dip into your investments when there's an emergency. Your investments are not an emergency fund. On your credit cards are not your emergency fund either. We have health insurance because health bills, unexpected health bills, that's the biggest cause of personal bankruptcy in this country. Health bills shouldn't be totally unexpected because you presumably have health insurance. So you must have that in place because people who are successful had health insurance, so they didn't have to dip into their accounts every time they had a giant health bill. You could decide for yourself what a big health bill is, but that's the point I'm making. The money's there for that. If they have health insurance, they have an emergency fund. The next is savings. And I'll give you an example. Like emergency fund and savings are different. Savings is for money that you know you're going to spend down the road. You're saving for something. I hate the expression saving for a rainy day. An emergency fund is for a rainy day. Savings, no, not for an emergency. Just think of it this way. You could disagree with me later, but savings is not for a rainy day. Savings is for something that you know is coming your way. Brakes and tires for your car is not an emergency if you are saving for it. You know your car is going to need maintenance in a certain amount of time. Don't wait for it to break. You know at a certain amount of miles you have to do something for your car. You know maybe in 10 years your house needs a new roof. So don't let 10 years go by and then all of a sudden you have a bad leak in your roof and you say, it's an emergency, I have to do something. You should be saving for these things. Now we could debate how much money you should have in savings, but you more or less know what's going to need maintenance in your home or your car or your business. Savings. The next thing is investing. After you have step 1, step 2, step 3, you get into investing. And that's when you could say, I am in the 401k plan. I am putting money into a Roth IRA. I am investing monthly dollar cost averaging into a brokerage account, accumulating investments every month. Then you get to that. But that doesn't come until the first 3 parts. Now, I'm not talking for someone like a kid who just graduated college where they should have the emergency fund and the savings account and the health insurance and all that. Okay, because generally speaking, if you're living at home, you're a child, you're still living with your parents, in that case, the emergency fund and the savings aren't maybe quite as important, so you can start contributing to your 401k as soon as you get your first job. And I advise doing that. This is more like for people who are past that youthful stage of living at home with your folks, okay? Most of the people I speak to who are set for retirement, well, let's put it this way. Everyone I know who's set for retirement has followed these steps. Now we could talk about investing. And when you get into investing, this is where you start to really get into the nitty gritty of asset allocation, investment strategy, deciding between individual stocks or, for example, index funds. There's so many ways to invest. And I don't want to sit here and tell you how you should invest. It's a personal finance situation. My own feeling is most people are better off with more diversified types of investment products like index funds or it could be actively managed funds too. But let me just say this. Diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Okay, just have to say that. Diversification is not a guarantee or shield against the down market. All right. So once we get into the investing, we're talking about tax strategy then. Like, should you put money into a Roth IRA, into a traditional IRA, a Roth 401k? And now with SEP IRAs, there's a Roth component to those as well. And if you're in a Roth 401k, the company match now can go into the Roth 401k as opposed to the traditional tax deferred account. We could get into the difference between all of those, but there's only so much time, and I really am passionate about getting through these topics. And then once you get through your investing, another thing that virtually every successful retiree I see is they all have their homes paid off basically by the time they're 60. Some 50 on the early side, but typically between 50 and 60, they've got their houses paid off. And I just had a conversation with a really nice man who gave me a call, and he's paying down his mortgage. And that's great. He's paying down his mortgage every month. I'm like, that's great. He has no emergency fund. None. So if anything happens and one of his kids, I think, needed dental work, and that was a couple of $1,000s, there wasn't a fund for that. There was no savings for that. So that's great. You're paying down your house, but the money that you're using to pay down your house, in addition, above and beyond your minimum mortgage payment, if you don't have an emergency fund, stop paying down your mortgage and let money accumulate in your emergency fund. Put that aside and then start accumulating money in your savings account, because if your child is going to need braces. You know if you're going to need something coming up for yourself or for your home or for someone in your family. That's what the savings account is for. And then talk about either investing or paying off your home. All right. So our time is getting close to being up already. It's just the time goes so darn fast. I'm talking kind of, intensely because I'm very intense about these particular subjects. And I see this. I know what works. And I just want to share this with you. Thank you so much for listening. Money in the Morning with Mitch Goldberg. To learn more about me, and if you want to take this conversation offline, check out moneyinthemorning.info. You are listening on 103.9 LI News Radio. Check out the LI News Radio app. It works great, and you can take us anywhere on the road. Have a great day, and I can't wait to speak with you soon. Bye.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views